Sir, we've lost everything. The words that ended a legend, November 15th, 2023. After 38 years of hunting down Wall Street's biggest frauds, Jim Chanos was about to become the hunted. This was the man who exposed Enron before anyone else smelled the smoke, who made billions predicting corporate collapses that seemed impossible, and who turned skepticism into a science and doubt into a fortune. But today he was packing up forever. $6 billion under management had shrunk to just $200 million. The greatest short seller in Wall Street history wasn't just wounded, he was dead. And his killer? A car company. Not just any car company, though. This particular car company barely turned a profit, missed deadlines constantly, and was run by a man who seemed more interested in Twitter feuds than Tesla factories. David Einhorn, who'd predicted Lehman Brothers' collapse, watched his own fund bleed 34% in a single year. Gordon Johnson, after 15 years of predicting Tesla's bankruptcy, had become Wall Street's most public failure. Andrew Left, who'd built a career exposing frauds, now sat in federal custody charged with fraud himself. $40 billion. That was the final tally. $40 billion transferred from some of the smartest minds on Wall Street to amateur investors who'd learned about Tesla from TikTok videos and Reddit forums. But here's what made this massacre truly terrifying. It wasn't a market crash that killed him, not an economic collapse or financial crisis, not even Tesla becoming profitable. It was 13 characters typed on a smartphone by a man stuck in traffic. August 7th, 2018 at 12:48 p.m., the moment Elon Musk accidentally discovered how to weaponize social media against Wall Street. What started as a single tweet would evolve into the most sophisticated financial warfare operation in modern history. To understand how Tesla became Wall Street's nightmare, you have to go back to when Wall Street thought Tesla was a joke. 2010. The company had just gone public at $17 per share, and the smart money was betting it would be bankrupt within 2 years. The logic seemed bulletproof. Electric cars were golf carts for environmentalists who couldn't face reality. Tesla wasn't a tech company, it was a car company pretending to be something revolutionary. And car companies required billions in capital, decades of manufacturing expertise, and established dealer networks that Tesla simply didn't have. After all, General Motors had been perfecting automobiles for over a century. Ford had revolutionized manufacturing with the assembly line that changed the world. Toyota had mastered lean production and quality control to near perfection. These weren't just companies. They were industrial empires built on generations of hard-won knowledge, powered by relationships that took decades to establish. Tesla, by stark contrast, was run by a PayPal entrepreneur whose automotive experience consisted of owning expensive sports cars and reading about manufacturing on the internet. Elon Musk's plans, if you could dignify it with that term, was to build luxury electric vehicles and somehow convince America to abandon a century of gasoline addiction. Which is exactly why Wall Street's apex predators started circling Tesla with predatory anticipation. These weren't ordinary investors looking for quick profits. They were the financial elite who'd made vast fortunes by spotting doomed companies before the market realized they were walking dead, then profiting from their inevitable collapse. Leading this pack of financial predators was Jim Chanos, the short seller who'd become a Wall Street legend by exposing Enron years before its spectacular collapse shocked the world. When Chanos looked at Tesla, he saw every red flag that had made him rich over decades of corporate detective work, massive capital expenditures burning through cash like a furnace, production targets that seemed more like fantasies than forecasts, and a CEO who promised the moon while delivering delayed prototypes and broken promises. Joining the hunt was David Einhorn, the hedge fund legend who'd made billions shorting Lehman Brothers before anyone else understood how fundamentally rotten the investment bank really was. Einhorn's thesis was elegantly simple and devastatingly logical. Tesla was a house of cards built on government subsidies, creative accounting that would make Enron executives blush, and the kind of spectacular hype that had made internet companies worth billions during the dot-com bubble before reality crushed them. Then came Gordon Johnson, an analyst who would become Tesla's most persistent and mathematically rigorous critic. Week after week, Johnson appeared on CNBC with meticulously prepared spreadsheets proving that Tesla's business model was fundamentally broken at its core. Every car they sold lost money when you properly accounted for development costs. Every promise Musk made was mathematically impossible to fulfill given the constraints of physics and economics. Every quarter brought them measurably closer to inevitable bankruptcy. The data supported their pessimism with mathematical precision. Tesla was hemorrhaging cash every quarter, missing production deadlines by months rather than weeks, and struggling with basic manufacturing challenges that Detroit had solved decades earlier through painful trial and error. In 2013, the company came within weeks of bankruptcy, a terrifying fact that Musk would later admit publicly when he no longer had to worry about spooking investors. By 2013, this growing skepticism crystallized into an unprecedented level of short interest. 40% of Tesla's available shares were being borrowed and sold by investors betting the company would collapse. That meant 4 out of every 10 Tesla shares were held by people who profited when the stock fell. It was one of the most heavily shorted stocks in market history, a level of coordinated skepticism usually reserved for companies on the verge of bankruptcy or fraud exposure. The short sellers had every rational reason to feel supremely confident in their analysis. They represented centuries of combined Wall Street experience, billions in assets under management, and analytical frameworks that had successfully identified countless fraudulent or failing companies over decades of market cycles. They possessed institutional relationships that took generations to build, regulatory connections that provided inside insights, and the kind of hard-earned credibility that came from being right more often than wrong in the brutal world of financial markets. Act 2. The Cult Awakens. June 22, 2012. Tesla delivered its first Model S sedan to customers who'd waited years for this moment with religious devotion. What happened next defied every assumption Wall Street had made about how car companies work, how customers behave, and how markets respond to corporate storytelling. These weren't typical car buyers making rational purchasing decisions based on price and features. They were tech executives who'd made fortunes during the internet boom and wanted to invest in the next revolution. Environmental activists who saw electric vehicles as salvation for a dying planet. And early adopters who craved being first to experience tomorrow's technology today. But more importantly for Tesla's future, they weren't just customers. They were converts to a mission bigger than transportation. Within weeks of those first deliveries, online communities exploded around Tesla ownership with the intensity of a social movement. Forums, Facebook groups, and Reddit communities where owners shared every detail of their experience with obsessive devotion. They troubleshoot problems together like technical collaborators, celebrate software updates like religious holidays, and defend Tesla against any criticism with the fervor of true believers protecting their faith. But here's what made Tesla fundamentally different from every other car company in automotive history. These customers immediately started buying Tesla's stock with the same passion they'd bought Tesla cars. Lots of it. They weren't just satisfied customers who might recommend the product to friends. They were shareholders who treated every Tesla delivery, every positive review, every production milestone as a personal victory in their war against the status quo. Tesla's stock began climbing with surprising persistence, not because the fundamental business metrics had improved. The company was still losing money every quarter, but because something unprecedented was happening that traditional financial models couldn't quantify or predict. A customer base was organically transforming into an investor army, and they possessed something Wall Street's sophisticated mathematical models couldn't account for: unshakable faith in the mission. Meanwhile, Musk was making a discovery that would ultimately change everything about corporate communications and market manipulation. While other CEOs communicated through carefully crafted press releases, approved by teams of lawyers and PR professionals, Musk started tweeting directly to customers, investors, and critics with unprecedented transparency. What began as innocent production updates and behind-the-scenes factory photos soon revealed something incredibly powerful. His words moved the stock price with measurable precision. A positive tweet about production numbers hitting targets, the stock jumped 3% within hours. A photo of a sleek new prototype that looked like science fiction, up 2% by market close. An optimistic comment about the company's future prospects, up 4% on massive trading volume. Musk was accidentally discovering that in the age of social media and instant communication, CEO statements had become a form of market manipulation, even when manipulation wasn't the conscious intent. Traditional analysts found themselves completely baffled by these market dynamics that violated everything they'd learned about how stock were supposed to behave. Stock prices were supposed to move based on quarterly earnings reports, revenue guidance updates, and fundamental business metrics like market share and profit margins. They had sophisticated financial models that accounted for competition analysis, market size calculations, and economic cycle predictions. None of their carefully constructed models had variables for CEO tweet sentiment or customer evangelism coefficient or social media narrative momentum. The short sellers were getting genuinely nervous as their carefully researched positions moved against them with increasing persistence. Their mathematically sound positions were underwater and climbing higher every day despite Tesla's continued losses, production delays, and the kind of quality control issues that would have destroyed traditional automaker stock prices within weeks. June 3, 2018, the day Musk fired the first deliberate shot in what would become a full-scale financial war that would reshape modern markets. "These shorts want us to die so bad they can taste it," he tweeted to his millions of followers. It was absolutely unprecedented in corporate history. CEOs simply didn't attack investors publicly like street fighters. They didn't turn financial markets into personal battlefields where reputation and ego mattered more than quarterly results. Wall Street was genuinely horrified by this brazen violation of every unwritten rule that governed corporate behavior. This shattered decades of carefully maintained protocols about how public company executives were supposed to conduct themselves. CEOs were supposed to be diplomatic ambassadors for their companies, measured in their public statements, respectful of all investors, even those betting against their success. Musk's tweet was like declaring war on the financial establishment itself, challenging the very foundations of how Wall Street expected to be treated. The short sellers struck back through their traditional weapons: coordinated media influence and carefully orchestrated regulatory pressure. David Einhorn appeared on CNBC calling Musk's behavior increasingly erratic and unprofessional. Jim Tanos questioned Musk's mental state in Bloomberg interviews that reached millions of investors. Gordon Johnson became an almost daily fixture on financial television, appearing with the persistence of a prosecutor to explain why Tesla's CEO was having a very public psychological breakdown. But instead of backing down like any conventional CEO would when faced with such coordinated professional criticism, Musk escalated the conflict with the recklessness of someone who discovered a new form of warfare. He accused short sellers of spreading coordinated lies about Tesla's prospects, hiring private investigators to dig up dirt on the company's operations, and orchestrating sophisticated media campaigns specifically designed to destroy Tesla's stock price through fear and uncertainty. Each accusation was more explosive than the last, turning what should have been dry financial analysis into intensely personal warfare that captivated financial media. What the short sellers completely failed to understand was that Musk wasn't just fighting them in the traditional arena of financial analysis. He was teaching his growing army of retail investors to see short sellers as enemies of progress itself. Every attack on Tesla's valuation became an attack on the mission to save the planet from climate change. Every bearish research report became proof of Wall Street's fundamental corruption and resistance to innovation. But Musk was about to learn that weaponizing social media against financial institutions was like playing with dynamite in a crowded room. One wrong move, one poorly timed tweet, and it could destroy everything he'd spent years building. Act 3: The nuclear option. Summer 2018, Tesla was drowning in what Musk desperately called production hell. The Model 3 was finally scaling toward meaningful numbers, but the psychological and physical pressure was crushing everyone involved in the operation. Musk was sleeping on the factory floor like a homeless person, working 100-hour weeks that would have killed most executives, and fighting simultaneous battles on every conceivable front. Suppliers who couldn't deliver parts, investors who questioned every decision, media outlets that scrutinized every delay, and now the short sellers who seemed absolutely determined to see Tesla fail. Then, like a mirage appearing in the desert, when death seems certain, salvation materialized from an unexpected source. Saudi Arabia's sovereign wealth fund approached Tesla about a potential investment that could solve all their problems instantly. They expressed serious interest in taking Tesla private, removing it from the public markets entirely, where short sellers could attack it daily. No more quarterly earnings calls where every word was scrutinized. No more short seller attacks coordinated to maximum damage. No more stock price volatility that distracted from the mission of building the future of transportation. August 7th, 2018. A Tuesday afternoon that would change financial history forever and demonstrate the terrifying power of social media in modern markets. Musk was driving from Tesla's Fremont factory to Los Angeles for crucial meetings about the company's future. Stuck in the legendary nightmare traffic of the 405 freeway that turns every journey into an exercise in psychological endurance. His phone buzzed constantly with messages about the Saudi deal, each notification building the tantalizing possibility of escape from Wall Street's torture chamber of quarterly performance expectations. At exactly 12:48 p.m., frustrated by traffic that wasn't moving and emboldened by the intoxicating possibility of freedom from his financial tormentors, Musk made a decision that would trigger a financial earthquake felt around the world. He pulled out his phone and typed a message that would either liberate Tesla from its short seller tormentors forever or destroy the company entirely in a blaze of regulatory fury. "I'm considering taking Tesla private at $420, funding secured." The reaction was instantaneous and absolutely devastating to anyone positioned against Tesla. The stock exploded 11% in exactly 13 minutes, creating $7 billion in market capitalization from 24 carefully chosen words. Trading volumes surged to 10 times normal levels as algorithms and human traders alike scrambled to understand what was happening, forcing Nasdaq to halt trading twice to prevent complete market chaos. On trading floors across Wall Street, the Tesla short squeeze created scenes of absolute pandemonium that veteran traders would remember for decades. Sophisticated algorithms designed to detect market-moving news triggered massive buy orders worth hundreds of millions of dollars in seconds. Human traders scrambled desperately to understand what was happening, while their risk management systems started flashing red warnings as short positions hemorrhaged money faster than their computers could calculate the mounting losses. Jim Chanos, the master of short selling, who'd built his legendary reputation over 38 years of methodical analysis, watched his carefully constructed Tesla short position lose hundreds of millions of dollars in the time it took to send a tweet. David Einhorn's fund started bleeding cash so rapidly that his risk officers were calling emergency meetings to discuss position limits. Every major Tesla short seller was getting obliterated simultaneously in a coordinated financial massacre. At SEC headquarters, phones rang nonstop as regulators scrambled to understand the implications of Musk's announcement. If Musk was really taking Tesla private at $420 per share with genuinely secured funding, this would be the largest corporate buyout in American history, requiring immediate regulatory oversight. But if he was lying, if he was manipulating Tesla's stock price with false information about non-existent deals, this was securities fraud on a scale that could send him to federal prison for years. Financial journalists at Bloomberg, Reuters, and the Wall Street Journal went into complete overdrive, calling every source they had, digging through Saudi investment funds documents and trying desperately to find any evidence of the mysterious secured funding that Musk claimed existed. What they discovered instead was absolutely terrifying for Tesla's future. There was no concrete deal, no signed agreements, no confirmed financing structure, just preliminary conversations that barely qualified as serious negotiations. Tesla's board called emergency meetings that lasted through the night as lawyers filled every available conference room. The company's entire future balanced precariously on a knife's edge of regulatory interpretation. If Musk was charged with securities fraud for manipulating the stock price with false information, Tesla could collapse overnight, taking thousands of jobs and billions in shareholder value into financial oblivion. SEC investigators worked around the clock building what they believed was an airtight securities fraud case that would send a clear message about market manipulation through social media. Musk had made material statements about Tesla's future without any solid factual basis. He moved the stock price dramatically with false information about non-existent deals. He'd potentially cost short sellers billions of dollars through deliberate market manipulation disguised as corporate communication. But Musk, showing the same defiant recklessness that had got him into trouble in the first place, refused to back down gracefully or accept responsibility for his actions. Instead, he mocked the SEC with a juvenile joke that made his legal problems infinitely worse and demonstrated complete contempt for regulatory authority. His lawyers were absolutely horrified by this escalation. His board was furious about this additional provocation. The financial media smelled blood in the water and circled like sharks sensing a kill. September 29, 2018, after weeks of legal warfare that brought Tesla to the absolute brink of regulatory destruction, Musk finally accepted the harsh reality of his situation. He agreed to pay $20 million in personal fines, while Tesla paid another $20 million in corporate penalties. Most significantly, Musk stepped down as Tesla's chairman and accepted that all his future market-moving communications would require pre-approval from Tesla's lawyers, essentially putting a regulatory muzzle on his social media weapon. Wall Street thought the war was finally over, and they had emerged victorious. The cowboy CEO had been tamed by regulatory authority. Tesla was under permanent SEC supervision that would prevent future social media manipulation. The short sellers had survived their darkest hour and could return to the comfortable business of destroying Tesla through traditional analytical methods without interference from rogue tweets. They had absolutely no idea what monster they just created through their regulatory victory, because Musk hadn't learned to be more careful with his words or more respectful of financial institutions. He'd learned something far more dangerous to the existing power structure. Exactly how much devastating power those words possessed when wielded strategically against his enemies. Act 4. The Great Obliteration. While lawyers argued endlessly about the legality of tweets and regulators crafted new rules about social media communication, something absolutely remarkable was happening inside Tesla's factories around the world. The company wasn't just solving its notorious production problems, it was revolutionizing automobile manufacturing itself with a kind of innovation that Detroit had thought impossible. By 2019, Tesla was building cars faster, cheaper, and with higher quality than anyone thought possible for a company that had been struggling with basic manufacturing just years earlier. The Model 3 didn't just succeed in the luxury sedan market, it obliterated the competition so thoroughly that it redefined what success looked like. BMW's 3 Series, Mercedes C-Class, and Audi A4, cars that had dominated luxury markets for decades through superior engineering and brand prestige, were suddenly irrelevant relics of a gasoline-powered past. Tesla's Shanghai Gigafactory came online ahead of schedule and under budget, defying every prediction about the challenges of manufacturing in China. European sales exploded beyond all projections as consumers discovered that electric vehicles weren't compromises, but improvements over traditional cars. The company that Wall Street said would never scale internationally was suddenly the world's most valuable automaker despite selling a fraction of the vehicles produced by Ford or General Motors. 2020 delivered the final death blow to every short seller thesis that had seemed mathematically unassailable. Tesla reported its first profitable year, $721 million in net income that proved the company wasn't just surviving the transition to profitability, it was thriving in ways that made its early struggles seem like ancient history. Wall Street's most sophisticated analysts found themselves scrambling desperately to understand how they had gotten everything so spectacularly wrong about Tesla's prospects. Their carefully constructed financial models had predicted that Tesla wasn't supposed to be profitable yet, that their margins were too thin to sustain growth, that the competition was too fierce to allow dominance, that the capital requirement was too massive to overcome. Yet somehow, through methods that defied traditional automotive economics, Musk had achieved the seemingly impossible, scaling production while maintaining profitability. Tesla stock began what could only be described as a rocket ship trajectory to financial orbit that defied every known law of market gravity. $400 seemed expensive until it hit $600, 600 seemed unsustainable until it reached 800. 800 seemed impossible until it crossed $1,000 per share. Each milestone represented billions in additional losses for short sellers who'd bet everything on Tesla's failure and now watched their life's work evaporate. Jim Chanos was forced to admit the obvious truth that was destroying his career. "This has been painful, clearly," he told Bloomberg in an interview that felt like a financial obituary, borrowing Keynes' famous observation that markets can stay irrational longer than investors can stay solvent. His fund's assets under management had shrunk from $6 billion to under $1 billion, a decline that represented the destruction of a lifetime's work. David Einhorn's situation was even more catastrophically worse than Chanos' steady decline. Greenlight Capital lost 34% in 2020, largely due to Tesla's relentless rise that contradicted every assumption about market rationality. Investors who trusted Einhorn with their money for decades started pulling out en masse, abandoning the man who'd correctly predicted the Lehman Brothers collapse but couldn't predict Tesla's incredible success. December 2020 delivered the final humiliation for Tesla's institutional enemies and the ultimate validation for Musk's unconventional approach. Tesla joined the S&P 500, forcing index funds to buy $78 billion worth of Tesla shares, whether they wanted to or not. The stock reached stratospheric heights that made early doubters look foolish and early believers look brilliant. By early 2021, Tesla's market capitalization hit $1 trillion, more than Ford, General Motors, and Toyota, companies that had been building millions of cars for decades. A company that sold fewer than 1 million cars per year was suddenly worth more than companies that sold 15 million cars per year, a valuation that defied every traditional metric used to evaluate automotive businesses. Musk became the richest person in the world, his net worth fluctuating by billions daily, based entirely on Tesla's stock price movements. To celebrate this victory over his short seller enemies, he started selling Tesla-branded short shorts as merchandise to mock the investors who bet against him. They sold out in hours, generating millions in revenue from what was essentially an elaborate financial joke at his enemies' expense. The war seemed definitively over, with Tesla emerging as the clear victor. Musk had proven the narrative could triumph over traditional analysis, that social media could defeat sophisticated institutional research, that retail investors could destroy hedge fund legends. He'd won the greatest financial war in modern history. So what did we learn from Tesla's secret war against Wall Street? What lessons emerged from the greatest financial battle in modern history? And what do they tell us about how power really works in the age of social media and instant communication? First lesson: in the social media age, narrative matters more than numbers. Story matters more than spreadsheets. And the person who controls the conversation ultimately controls the valuation. Tesla's stock price moves on promises and potential futures, not just quarterly earnings and traditional business metrics. Second lesson: traditional gatekeepers have become obsolete and irrelevant in the information age. Financial journalists, Wall Street analysts, and institutional investors used to control information flow and market narratives through exclusive access and professional relationships. Now anyone with a smartphone and enough followers can move billions of dollars in market value with the right message at the right time. Third lesson: the democratization of information has led to the democratization of financial power in ways that are both liberating and terrifying. Retail investors can now coordinate research, execute sophisticated strategies, and move markets like institutions, but they can also be manipulated and misled more easily than professional investors with decades of experience. The fourth lesson: CEOs have become media companies with more influence than traditional news organizations. Musk has 226 million followers on X, which gives him more direct reach than CNN, Fox News, and the New York Times combined. When corporate leaders become influencers, the line between information and manipulation disappears completely. Fifth lesson: being right about the facts isn't enough anymore if you're wrong about the story people want to believe. Jim Chanos was absolutely right about Tesla's early financial struggles and production challenges, but he was catastrophically wrong about the market's willingness to pay for potential rather than performance. vision rather than current results. Tesla trades at around $400 today. Is that price too high based on current fundamentals? Too low considering future potential? The honest answer is that nobody knows anymore, and that uncertainty itself has become the point of the entire exercise. Chinese manufacturers like BYD are scaling production faster and cheaper than anyone thought possible, threatening Tesla's market position in the world's largest automotive market. Tesla's first-mover advantage is shrinking as established companies learn from Tesla's innovations and improve upon them. Tesla's secret war changed everything about how we think about investing, leadership, and the power of communication in modern society. On one hand, traditional institutions, fundamental analysis, quarterly earnings, regulatory oversight. On the other hand, viral narratives, retail coordination, celebrity CEOs, and the awesome power of collective belief. Tesla proved that in the modern world, the most dangerous person in any room isn't the one with the most money, the best analysis, or the deepest experience. It's the one who knows how to tell a story that people desperately want to believe, regardless of whether that story is true. If you made it this far, you're not just watching. You're part of the story. I love digging into this war between Tesla and the market. And if you want more stories where billions are on the line and where one wrong move can erase it all, then you're exactly the kind of person I made Darko for. Click the button, join the channel, and step inside the boardroom where these battles are fought. Because the next story we tell might just change the way you see the market forever. But either way, thanks for watching, and I'll see you next time. Cheers!